My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people to make friends, I'm just trying to save you some money. My job is not just to entertain and educate, but to put days, ugly days like today, in context for you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We call it a crescendo. That's when all the selling comes to a head, like a discordant symphony. And the instruments crash to a beautiful conclusion. After an ugly day where the Dow lost 308 points, the S&P dropped 0.76%, and the Nasdaq tumbled 1.12%, I want to talk to you about the last big crescendo, the one that we got exactly 1 year ago today. And that's when a tsunami of selling wiped out the weak hands and the market bottomed. Except unlike a symphony, many of us didn't realize it was happening. It's like we were all wearing earplugs, except some of the younger investors who rushed in when the big shots were rushing out. They'll like the fact that Robinhood seemed to file for a confidential IPO tonight. Now, since then, since last year, we have had a huge run. But now the market's selling off again. So I think it's important to review what happened last time, as it's getting pretty darn ugly pretty fast out there. First, I have to give a nod to the late Mark Haynes, the man who ruled Squawk Box and Squawk on the Street for so many years. He's the one who called the bottom in March of 2009. He loved looking at ratios to spot the crescendo, and he nailed that one when the sellers overwhelmed buyers on a 9-to-1 ratio. To him, that kind of extreme selling meant that everyone was giving up at once. That's textbook bottom behavior. Me, I like to see how many stocks have become what I call AHYs. Accidentally high yielders, meaning the share price has fallen so fast and gone so low that once meager dividends suddenly become much larger yielders. I wish I could say our indicators work, but last year's bottom was very sneaky. While the averages hit their lows on the 23rd, the actual crescendo occurred a few days earlier on the 19th. And that's when there were 79 companies in the S&P 500 that had declined 50% and now sported 5% yields. Wow. 119 stocks were down 40% with a 4% yield. What a field day. But the worst overall for the averages was yet to come. The ultimate bottom 1 year ago was when the Dow sank to 18,213. Now, that's down more than 11,000 points from the peak. It looks very different from what we're talking about. I mean, this is amazing because this happened so fast. It was the fastest that we've seen, even faster in some ways than the Great Depression. Even though it was hideous, it was a ball of confusion when we got down here because many stocks internally had already started to rebound. They just weren't important enough to prop up the averages. These rebounding stocks went on to become the biggest leaders of the market. The COVID beneficiaries were part of what many started calling the Great Reshuffling. That's a term I first heard on a Zillow conference call, a great one, where they were talking about an urban exodus that led tons of people to buy homes in the suburbs or in the country because they could get away with working remotely. Those stocks started going up even as the market was going down. Now, the market had been falling for a full month, and that's what I'm showing here, before March 23rd, okay? The Dow didn't hit terra firma until it had fallen 11,000 points from its February high. That's 11,000 points. While Wall Street was complicit in this crescendo of selling right here, with a host of downgrades and give-ups at the absolute low, it wasn't wholly responsible for the decline. That would be unfair. Sure, you had notable downgrades like this. Just to give you a sample. That day, Wells Fargo took Carnival from hold to sell, and that was at the bottom. They cut its price target from $53, Dream On, to $6 because the cruise lines were at the epicenter of the public health crisis, and Carnival in particular was desperate for liquidity. It was ultimately saved. There were downgrades everywhere in travel and leisure. Big cap tech stocks took it on the chin, but mostly because top-down strategists cut their overall numbers for the S&P. And tech's such a huge part of the S&P, well, that it hurt all of them. I mean, Apple's market cap dropped below $1 trillion. You know, it's now worth more than $2 trillion. Oh, it was a real ugly session, that bottom. However, if you want to point the finger, the real blame lies with Washington, specifically the total lack of leadership in Washington. That, and not Wall Street research, is what caused the crescendo. Congress was working on a gigantic relief package meant to tide us over until we found a way to beat COVID-19. But the night before, the bill seemed to stall in the Senate. The Democrats and Republicans just couldn't reach a deal, despite the chaos all around them. It felt like the catatonic days of 2008. Congress seemed incapable of recognizing its own impact on the economy or the stock market. Oh, the bill had looked indeed right here like a sure thing. But then it got snagged on some procedural nonsense, and then Wall Street completely freaked out right there. Even though the whole thing seemed like theater, frankly, exactly the kind of theater we saw in 2008 when TARP failed to pass the first time around, investors were once again faked out. The Dow plummeted 800 points from the day before. And while Treasury Secretary Mnuchin tried to calm the market by saying Congress was very close to a deal, the markets were not appeased. The economy needed help, and it needed help fast. Now, we knew we'd get some kind of stimulus eventually, but we didn't know the timeline anymore, and that made the delays so terrifying that you got this. Ironically, Mnuchin was right. Not only were they close, the bill went on to pass the Senate unanimously. However, it took a crashing stock market and a horrific weekly jobless claims number. In many ways, I thought that was the most important thing. It was the worst on record, 3.28 million, to get everybody on board. After they passed the $2 trillion aid package, the averages began their long climb from the abyss. And you know what? Until today, it felt like it's still going to climb. Now, but even when we bottomed, many investors refused to believe it. Unlike the Haynes bottom in 2009, you couldn't see this one through the prism of up and down ratios. What made it so confusing? Like I said before, there were a whole group of stocks that had bottomed a few weeks before because they were actually benefiting from the pandemic. By the time the averages turned around, these COVID plays have been going up for weeks. And there, I want you to think of the stay-at-home plays. Remember how exciting Zoom was, DocuSign, Etsy, still going strong, Shopify. Think about the payment plays like PayPal, Square, and the like. They were already gaining adherence, even as the broader economy was still getting crushed by the lockdowns. These stocks were the key components of what we call the Cramer COVID Index because they were doing great before March 23rd. Remember, this is when they started gathering steam. Now, they did come into the downturn doing well, but wow. And then they just got better and better. But that meant there was no uniformity to the sell-off, and it threw a lot of people off the scent. It was a changing of the guard moment, and you had to be nimble enough to realize the money was going out of the losers and into the new winners, even as the averages made it look like everything was going down. Turns out there were a lot of winners. Unlike a typical downturn, vast swaths of the U.S. economy thrived during the pandemic as Americans adjusted en masse to work at home. The primacy of the central office ended right here, and the Zoom ecosystem took hold, something that is still with us even as we're getting vaccinated at record levels. The moral of the story, a year ago, you got a bottom when Washington stumbled and Wall Street panicked about the prospect of a much-needed aid package, thought it would be scrapped. If you panicked on that day, you blew it because it should have been obvious that a huge stimulus bill was inevitable. Our leaders had no choice but to reach a compromise, which is exactly what they did 3 days later. The darkest moment really did come before the dawn. You just had to anticipate that they'd screwed it up once, exactly like they did in 2008, causing a panic that ultimately helped pass the bill in itself. The bottom line, a year ago, we caught a weird bottom as the market experienced a changing of the guard with the COVID winners taking over as the new leaders. Now we're being dragged down by a similar leadership change. And while I know we'll bottom eventually, it might take a while before we get a crescendo this time, too.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.